Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday, the 6th of May, 2022. As always, this is general commentary and doesn't take your personal situation into account. All right, with that said, let's jump to our first chart. So what we've got the S&P 500 on the screen. And if we were just looking at closing levels, you'd think that it actually been a pretty quiet week because the market is pretty much where it was on basically about a week ago. But the S&P 500 has actually traded in a range of about 6%. So there's actually been a whole lot of movement despite the underlying price being where it was a week ago. And that's just the nature of these corrective periods. They're just by nature they're volatile and they're really difficult to make money in. Even if you're a short seller, if you'd been trying to short this market, say you look at these lows and you sold on the break of the lows, which would be a natural thing to sort of think would be a good strategy. The strength of these short covering rallies are such that they're really hard to stay in, and the risk reward parameters of trying to trade short these markets, they can be difficult. Like get short here and you get this quick downdraft, so that's all good. But then you do get these sharp moves back, and they lack the consistency of those nice strong upward trends during a bull market. So look, it's just one of those difficult periods. And so look, I've got some support. I've already drawn some support in here, and that comes in around that 4,100 sort of mark. There's not a whole lot to work with, so you can see we're picking up some lows from through here back around May 21, so May last year, and we've got the lows from just recently in March. Other than that, there's not a whole lot going on here support-wise because the market is at historic highs, and just the nature of this rally off the COVID lows, it was quite a powerful rally. There wasn't a whole lot of work done, so that's why we don't have a great deal of support to sort of hinge our analysis from. But look, that said, the support so far has been holding. It's been holding through the week despite all that volatility that we've been seeing. And I think just looking at this, one of the possibilities that could be playing out is that we could be getting a double zigzag downward movement. So just drawing our first zigzag. So the first zigzag was from the high through to the March lows. So you can see this ABC type of pattern. Then we've had that big short covering rally, and it's quite a complex type of correction, but it is one that does play out reasonably frequently. So we've got the first zigzag, got that short covering rally. It's possible that we're now getting a second zigzag that could go something broadly, roughly like that. And what we can also do a measured move of this first decline. And so we take that, there's our first decline, and then we had our rebound. And a measured move would give a target somewhere down around this 3,900 sort of mark. So look, that's one possibility that the market does something like that. And if I just measure that out, let's just see how far that is from the high. So that comes in at around, it comes in around that 18% sort of mark. So look, it's possible that this is how the market gets to that long-awaited 20% correction that has been, it's been speculated and spoken about for maybe about a year or so now, all the way through here, people talking about when's this 20% correction coming. This, and I've been talking about this for the last couple of months, that this whole pullback, I think, is a correction of this entire advance, which would be quite natural to see it do that 20% correction, which is something the markets do on average, maybe every couple of years. So it is due for that sort of event. Also interesting if we put some Fibonacci levels on just from those COVID lows up to the high, and you see that upper boundary of the Fibonacci's comes in just below where this measured move would be. So the measured move is sort of like more of a target rather than the specific technical point which the market has to get to. Let's get rid of that. And so look, you've got this cluster of potential targets around here that could occur. This is just a possibility. It's one scenario, and it hinges on, does the market bounce here and do this double zigzag? That may not be what's happening. But look, either way, I don't think this is a tradable move for most people. But I think simply being aware of this sort of scenario, I think it can help, because most people are just watching the ups and downs on the nightly news, and when you do that, it really can feel like you're in like a rudderless boat during a storm that you don't know what's going on. And at least when you understand some of the scenarios, some of the possibilities, emotionally, I think it does help, because you get some idea of where things could be going. Now, I'm going to I just want to jump over to a 4-hourly chart, because as always, these are good to get some more finer detail on what's been happening. And my feeling is, I think we could get a bounce, like I was just talking about. If we get that bounce as part of this second zigzag, that was like I was talking about a bounce maybe up to around 4,400, 4,500 potentially. And and of course, I'm saying this on Friday afternoon in Australia before the Friday session in the US has opened. So, whether we get a bounce off this support here, you may well and truly know that by the time you're watching this on Saturday or beyond. And I could get this spectacularly wrong, and that's okay, because this is the thing. I'm not claiming to know what's going to happen next, because I don't. Nobody does, despite what some people will tell you. And what we're doing here, the whole point of this is looking for those possibilities. So let me tell you why I think the market may bounce off this support. So firstly, it's a support zone. So support zones, we often tend to give the benefit of the doubt to. We say, look, if a market's on support, probability will favour that it will bounce. Doesn't always do that. Sometimes the support will break and the market will continue to fall, but probability favours that support will give some sort of reaction. And also I'm seeing that like market sentiment and market breadth are also looking excessively negative. So I'm going to come back and talk a little bit about that in a minute, because that's interesting on its own. And also this area here, let me just expand that out a little bit. So this area here doesn't look dissimilar to what we were seeing maybe around here. So we had the sharp fall into support, had a strong rebound, and the market then, maybe it's more like probably around here actually. We had this sharp fall into the support, rebound, retest, and then a rebound. It's kind of like what we're seeing here. We've had the sharp move in, we've had the rebound, retest. Maybe we then get another upward reaction, because the market is struggling to get beneath these low points here. Looks like maybe has become overstretched, oversold, as it did through this period, and we're close to some sort of a rebound. And one other interesting thing, I'm just going to duck over to an hourly, because I just want to focus in on this area through here. So let's just go to this hourly. Let me just compress that a touch for you. And I'm also going to show you an Elliott wave count. So Elliott wave, it's a specialized charting technique. I'm not going to go into detail about this. It's more than most people want to know. It's getting a little bit out there when you start talking Elliott wave, and it's not something I use on a day-to-day basis, but I did get some of my early charting training was in Elliott wave, so it's something I just look at with interest when some things sort of stand out on the charts. But it is interesting because I can see a 5-wave decline in this move. So let me just show you what I mean. Let me just search down here, and it is this one here I need. So an impulsive decline is in 5 waves. So you get a wave 1, a 2, 3, 4, 5, and that would complete a move. That would complete an impulsive move. And then after that, the theory is that then you'll get the upward correction. And that could be where we are now. We could have this 5-wave decline, which is then followed by an advance. And it's also interesting because this part here counts into 5 waves, as does this, as does this. So it all subdivides down. So look, it's nice and it's neat. And as I say, these aren't things that I use on a daily basis, but it's interesting. It's just interesting when some of these moves do stand out. So if you're interested in Elliott wave, you just Google it and you'll find plenty of information about it. So look, even if we do get this bounce, I do think it is a temporary reprieve, and I think this correction still has further to go, as I was talking about with that that double zigzag sort of decline possibility. And I think the play at the moment, I think the play at the moment remains being highly selective with buying. And I think it's also about exiting stocks or selling stocks that are losing too much ground. So you've got to give stocks room to move, but if they lose too much ground, I think it's really important to cut them because you don't know how low a correction can go. And what I do, I use trailing stop losses on all of my trades. And so that means I've got an exit point. I've got a pre-calculated exit point that I use for each stock. And that's one of the things I do with my Motion Trader subscription service. And the idea being is that you protect your capital and then you ride through the storm, because this storm will pass as they all do. And the winners out of these periods tend to be the people who lose the least. So just about everyone loses money during these periods. They're frustrating. Everyone gives back money. They're just difficult periods, but they're part of the cycle. And so the winners are the ones who lose the least and the ones who are then ready to take the new buy signals when they come. Because not everyone wants to take the new buy signals when they come, because they just get so beaten up and so expecting bad things to continue happening that they don't take the signals. So a couple of important points for coming out the other side. And just not a time for bold plays. I think trying to buy the low is just a risky game and leads to trouble. So what I want to do now, I just want to talk about sentiment, because I saw a fascinating graph through the week and some fascinating data that came with it. And so I've just prepared it myself with the data. And this is from the American Association of Individual Investors. And you can get this data yourself from their website. So their website is aai.com. And what it is, it's a survey. So what this business does, it does a weekly survey of investors. Their data goes back to 1987. So I love these long dated data series to look for patterns and sort of see how they play out. And really interesting in that at the end of April, the bullish percentage of investors fell to 16.4%. So just here, 16.4%. And if you look back over all these periods, it's the lowest level since back here. And that was in April 1992. So I thought that was quite extraordinary. So it's lower than during COVID, lower than the GFC, lower than the tech bust, and that was about a week ago. It's had a little bit of a bounce off there, and it's somewhere up around here now, but it is coming off this extreme low. So lows in the bullish percentage, they don't always match up with market lows. Sometimes these lows occur when the market might be at a record high and it's started to pull back. It's interesting to sort of match it up with an S&P 500 chart. So that's something you can do yourself. You get the data, you can do all those sort of overlays. But when you couple this when you couple this information with other data, it can be a useful contrarian indicator. And so it's an interesting exercise to do. And another thing I want to combine this with, if we go back to our trading view charts, what's also been interesting in the last week is just looking at coming back to our, you'd see this before if you're a regular viewer, the number of S&P 500 stocks above their 20-day moving average. So after that big 12% rally about a month ago, we got right up here at these historic highs, and that's when we started talking about saying, look, it looks like we are going to get some pause in this trend, and we're going to get a 5% or more pullback, which we certainly have got. What's happened now is this has come all the way back down to the point where it's at these extremes, and these extremes you often get bounces off. So we have had a bounce. We did have a bounce, a strong rally earlier in the week, and that's created the beginnings of a bounce. Now, whether this continues to move back towards the middle of the range from where we are now, or whether the market's going to try and break down below support and then we have a retest into this range, I don't know. We're just going to have to wait and see. But we are at that point where the market does tend to ricochet back to the upside. You can see it's got a long history of not staying down here very long. So we're currently at 23%, and again, you can see 23%, it doesn't stay there very long. Did during COVID, but that was quite extraordinary. So let's see what happens here. Let's see whether this support level that the S&P 500 on can hold, and let's see if we can get some sort of a bounce. So not a new bull market, but just a bounce probably within a bear market. Just going through, I want to go through some of these other ones with you as well. So this is the number of stocks above their 50-day moving average. And I'm going to put these on weeklies to give a different perspective on them. So this is interesting when you look at this series on a weekly chart. So we're currently at 30. We've been down as low as 16%. Sounds like it's really low, but then you do look at these ones here. That was a COVID low, we got down to only 3%. Here we're 3%. You get these lows down below 10%, and we're not currently below 10% yet. So I think this does have the potential, and this is another reason I think this bear market, well, it's not actually quite a bear market in the S&P 500 yet. It's got to be down 20% for a bear market, but I think this correction still has further to run, because I think the market may need to test down towards this 10% of stocks above their 50-day moving averages before we can sort of really start saying, okay, this looks like it's completely run its course. And we can also then look at the stocks above their 200-day moving average, and it's the same sort of thing. It is getting to lower levels, 36%, being down as low as 29%. But look at these other extreme periods, and you look at the time between them, and very roughly, broadly, you can see, well, look, maybe the market is getting due to one of those times where it does need to test back down to this 10%. Maybe it's even a touch higher on this one. You could say maybe it's like at least below 20% seems to be the excessive range for the stocks below their 200-day average. So that may still have further to run, which means this correction may still have further to go too. And that's why I think this washout still has further to go. But and as I've been saying, for a couple of months, I think this is all going to take time. It always does. That rebound from the COVID lows, that wasn't typical. That's not how these corrections or bear markets bottom out. We usually don't see the V-shaped recovery. They do happen, but more often than not, it's the market bottoms, it grinds sideways, it starts to grind upwards, then it starts to gather momentum, and that's how the bull market is usually born, on a whole lot of skepticism that it's not going to continue. I just don't think we're there yet. And now, if you're getting some value from this, please hit that like button, and please leave a short comment. Just hey Jason, thanks for the video. Something really short, really simple. Tells YouTube that people are engaging, people are watching, people are liking. And if that's happening, will I keep making more videos? So that really helps me. So please do that. Okay, so let's go over to the Aussie market and have a look at the ASX 200. So I'm going to jump back to the daily chart to get this going. And here we go. So I'm not going to spend too much time on this today. Overall, I think it's looking okay. It's still one of the structurally strongest markets in the developed world. The dominant pattern is this triple top resistance that we've got marked in on the chart. I think that's likely going to cap the market for, look, it could be for a few months before things settle down enough to get a break to the upside. And just looking at the weekly chart, so let's just come over here, we'll go back to this weekly for a sec, and just compress this, get some more data. So when I look at this, just looking at this weekly, this seems to be the pause that the market needed, I think. So we got this strong rally off the COVID lows. Market got stretched above the 100. This is a 100-week moving average because it's a weekly chart. Market got quite a bit above that 100-week moving average. And as I often say, the moving averages are a bit like gravity. The further extended a market gets, the sooner it is usually likely to come back and retest that moving average. You can see it all the way through here. Market stretched above, comes back and test, stretch above, comes back and test, and so on. You see it through this bullish phase here during the mining boom. Got stretched, came back. And that's pretty much what we've done now. So that's not unusual what we've seen. It's quite typical. And so far we're only 6% off that high. So it's like if you're an Australian investor, there's really, so far, there hasn't been any cause to get all worked up about this. This is very much so far stock standard. And it gives the indication at the moment that it is going to stay stock standard. Of course, that could change. We could even see a retest of this low at some point over the next several months. But even if that were to happen, that's only an 11% correction from these highs and just comes back to just beneath the 100-day moving average, which in itself isn't a particularly big deal. Like we saw during this period, the market did just get below the 100-week moving average and then continued higher. Here it got a bit further below, but then snapped back fairly quickly. So if the market were to come back here just below the 100-week moving average, everything still remains in place for being constructive. My feeling is that this period will set the ASX 200 up for new highs. I'm not expecting this to become a lengthy bear market at this point. The evidence isn't there to suggest that that's what's happening. Things can, of course, change, but we can only go off what we can see. And from what we can see at the moment, it looks constructive. But those same cautions apply. I think it's a case of you don't buy stocks below their moving averages, and you know where your exits are. I think everyone really needs to have exit points on their portfolios. Otherwise, you run the risk of riding a stock all the way into the ground. And look, I'll just quickly show you another high-profile casualty from this week. It's a high-flying stock, it was a favourite during the COVID period. And this week it's been falling away. So let me just quickly get this on the chart. It is a company called Breville Group. So as you can see, great performer during this COVID period. But look at this, and this is what I talk about, almost every week lately. Don't buy stocks which are trading below their moving averages. It's just a dangerous proposition because all the bad stuff happens, well, most of the bad stuff at any rate, most of the bad stuff happens below the moving averages. And you can see this has now been accelerating to the downside. So my Motion Trader subscription service signaled this as a buy. It was back mid, somewhere through here. It was back middle of 2020, rode this upward trend and gave an exit signal 2 months ago. The stock hit its trailing stop a couple of months ago. it might have been around this point here. So my method of staying with the stock, I'll always give money back at the end, but that's the price you pay to give a stock room to move and to stay on these big uptrends for as long as possible. And people who are here buying the dip or holding and hoping for a retest of the highs, well, they're in trouble now. It's a problem. What do you do? What do you do if you bought the dip through here? How long are you going to hold for? How long are you going to risk that it continues to come lower? What if it gets back down here? It's not a prediction that it will, but some stocks do. So if you're buying the dip and you're holding and hoping for a rerun of this period and it doesn't happen, well, that's when you fill your portfolio with lead, and that results often in quite a bit of underperformance. So look, just something to be aware of. Now let's leave the stocks there, let's leave equities there, and go over and let's have a look at gold, because it's really at a make or break point here. It's because it's starting to lose its footing. So the last few weeks I've been talking about gold having support through this region here, through around that 1880 sort of mark. And this week we've gotten below there, we've rebounded above, but it really does look like it is starting to lose its footing. It's just hanging in there at the moment. And I think really it's this week's low is now the key line in the sand, make or break sort of point. Like, we can give it a touch of margin below it, but really I think if the market does dip below there, I think it does put the bullish case on hold, and that the risk of an unwinding of this buying that we saw through here, the risk shifts that we start to see an unwinding of this buying, and that has the potential to bring the market back within the range, and from within the range you can then, before you know it, be testing the bottom of the range. So that's now the risk. That's now the risk with gold. I do like it longer term, medium to longer term. I think the overall chart structure is positive, but when we look at this near-term chart, I'm not going to argue with the price action. Doesn't matter whether I like it medium to longer term or not. Below here, we start coming back into this previous range, and it takes the wind out of the sail, and it shifts the momentum to the downside. You could still call, at the moment, you could still call this a zigzag decline, but that's really as far as the zigging and zagging can go. It needs to re-engage to the upside, and it really needs to re-engage now for the near-term bullish case to stay in play. So that's the state of it. I think, as I say, I think it's still got that really strong medium to longer term potential, but it's not about what we want. The market won't do what we want when we want. We can just look for the setups and run with them. And if those setups then start to roll over and fail, we've got to be aware of an alternate case to what used to be our base case. Maybe that needs to be amended. So that's the situation with gold. And very briefly, just let's a quick look at uranium, because we haven't spoken about this for the last couple of weeks. Technically, it's still holding in there. So there is a support region that comes in through. You can draw a support region in here around about, say, 1550-ish. You can find support from these, like there's some little bit of work there, their previous lows, highs, top of this region there, highs, some more work through there. So there's a bit of a robust sort of shorter term sort of support region. And we can also put some Fibonacci's on. So if we use that low there, find the market it's still within the Fibonacci retracement pocket. So from that perspective, it's all still holding in fairly well. And the overall bullish case, I think, is still well and truly intact. But like all commodities, what's happening at the moment with all the commodities, whether it be copper, gold, silver, uranium, pretty much all of them, oil's doing its own thing, but it's even pausing at the moment. all these markets, all these commodities, they're fighting the tide of both market volatility, and we're getting this risk-off sentiment coming into the market where people are just saying, look, I just want to sell stuff, and they're selling anything. And we've also got this surging US dollar. So surging US dollar is always going to be a headwind for commodities because commodities are priced in US dollars. So US dollars more valuable, the commodities priced in US dollars fall. So just getting back to uranium, these big bullish moves, if we want to look at uranium from a medium to longer term perspective, these big bullish moves, they take time. So I think if you're bullish on uranium, then I think it remains a case of, look, it's just about being patient. I think this still has the potential to become, just quickly pulling up the weekly chart on uranium, I think this is still the relatively early stages of what could become a really big trend that takes out this high. But that's not going to happen this week. That's not a trade for even this year. That's a trade for the next few years out. And so it does have that potential, but the timing and the pathway is always uncertain. So uranium could move sideways from here. It could move sideways for 6 months and could look even stronger when we look at this chart later on. But we just don't know. We just got to continue to watch that price action. At the moment, it's constructive, but I just don't think anyone should be holding on expecting that it's going to do that anytime soon. It looks like it's caught up with this whole risk off and strong US dollar scenario that we're currently getting. But from my perspective, I think this is still a highly potential play. So look, let's leave it there now for this week. That's enough from me. I hope that was helpful. Hope we got some good information from that. And please give me that like, and I look forward to coming back and talking to you again about these markets next week. So thanks, and bye for now.